The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Tech. My name's Gaurav Sodhi. Joining me today is analyst Angus. I'm not going to try that last name, Angus. I butchered it last time. I'm going to butcher it again. It's spelt wrong, I tell you. You're doing it all wrong.
Angus is fine.
Right, Gus. Who else is there? Oh, yeah, Nick. Our analyst Nick is with us as well. Good day, Nick.
Morning, Gaurav. Morning,
Sorry,
Gus.
I almost forgot about you there. It's quite hard to do, actually. Right, boys. We're not going to talk about the budget because, honestly, it's too frustrating. We're going to get too angry, and I don't want to start the morning that way. So let's go on to some other news. I thought something that would be completely without controversy and a nice, calming, relaxed discussion might be the Mayhem at Perpetual. Nick, give us an update about what's happening there.
Yeah, well, I mean, you mentioned it's the budget's frustrating. I think for a lot of shareholders, the last couple of years, the Perpetual's been just as frustrating. It's been a bit of a basket case. So the company's completed a strategic review, and that's culminated with KKR bidding and the board agreeing to that bid for the corporate trustee and wealth management business. So essentially, the trustees and wealth management business will go to KKR, and Perpetual will retain the asset management business. I think, from my perspective, it's just the culmination of just terrible decisions from management over a couple of years now. They famously bought Pendle, I think last year or 2 years ago. They bought
and they raised a whole bunch of equity at low prices to do that, didn't they?
I think they did. And they also used debt, which has now become a little bit of an issue for the business. And debt is really uncommon. It's really uncommon to see a balance sheet full of debt in fund management. And the reason it's simple is because, you have market and outflow risk, and that makes your earnings volatile. So most fund managers, you'll typically see heavy net cash balance sheets.
Yeah.
Perpetual's the outlier here, and sort of maybe rush the board's thinking into we have to do something and get some money in the door, which is the corporate trust, selling off the corporate trustee and wealth management business. I think the most amazing thing I find about it is only back at the end of 2022, they knocked back a $33 all cash bid from Regal.
Yeah, incredibly.
And now they're settling for far less, only 18 months on.
Not only did they knock that bid back, I think there was an approach by Solpats as well.
There was last year.
A very credible party, and they knocked that back. I don't even think that went to a lot of discussion. It was kind of mentioned briefly, rejected, and then the one that gets accepted is this wild bid, which is pretty crazy. So they're gonna offload their best business, which is the trustees business. They're going to lose their brand name, which is the biggest asset they have, a storied, centuries-old asset management brand, and they're going to be kept with the Aussie fund management business in a few years' time. Is that right?
Yes, and the global funds management business as well, because of those acquisitions. But another amazing stat from this is they bought Pendle for about $2.3 billion, and backing out what KKR is paying for the trustees and wealth management business, it values the funds management business at about $1.1 billion.
Wow.
And that includes all the other acquisitions they've made there and the Perpetual, brand that you talked about. It's absolutely insane.
Gus, what's your take on this? I mean, fund managers have been in trouble for a couple of years, including your old boss at Platinum. It's not just them. Magellan has famously blown up. The only one I can think of that's done relatively well is, GQG has done pretty well. They've got a bit of a different operating model there. And Australian Ethical has continued to attract funds. Again, that's more of a super fund than a traditional asset manager. Is this a sign that the whole industry is kind of stuffed? Or
it's interesting, isn't it?
Perpetual that's stuffed.
It's exactly what I've sort of been wondering about this whole thing, is how much is the pressure from your ETF providers, these giant foreign asset managers, just becoming too much for these, that when you look at something as simple as the houses that people that work for these companies tend to own and the nice cars they drive, you can see that there's quite a bit of fat in some of these businesses. How much is that competitive pressure? But it also seems like here there was some really significant missteps by management, and the whole thing is strange. And, I was looking a little bit into KKR, and it's interesting that, that political angle with the budget, Malcolm Turnbull works for them. But there's, a sort of big leverage buyout company coming in. It seems like there might have been some missteps that got them into this position in the first place. But obviously, it does seem to be an industry that is under pressure because, so many managers do sort of struggle to beat the market.
And I think the cost base on a lot of these fund managers is just way too high. And Perpetual is a classic example of that. You compare that to some of these smaller fund managers who they can run billions of dollars with 4 or 5 staff, and Perpetual had sort of hundreds of staff to support, and that prevented them from chopping prices. I mean, look at GQG. The fees that they charge are sort of I think it's like half of what Perpetual and some of the traditional asset managers charge, and they've been generating better performance as well. So it's very easy to see why asset allocators might tick that box. But I like your point about how this is really an own goal from Perpetual. The one thing that a lot of these bloated asset managers have in common is there's no one on the inside owns significant stock, and they make their money through bonuses rather than through appreciation of the value of the business. And I think that's perfectly clear here. This is a wild deal that I'm quite shocked actually has gone through. Soul Patts spoke about this in a recent interview, and they talked about their bid for Perpetual, and what they wanted to do was similar to what KKR has done. They wanted to strip out the trustee business in particular. I think that is a genuinely high quality, valuable business. But I understand they're willing to pay a lot more, so I'm not quite sure what happened there. There's been a long history of animosity between Soul Patts and Perpetual. For a long time, Perpetual's wanted to break up Soul Patts and Brickworks, and I don't think that those parties get along too well. But it's a crazy, crazy deal.
Yeah, absolutely. And just going back on that point that management hasn't, helped themselves here. The conference call that they had after announcing the deal was just a shambles. One analyst asked, could they, tell the investors the tax structure of the deal, so how much tax they expect to pay, capital gains tax, which is rumored to be a couple of $100 million. They couldn't do it. The separation costs, the restructuring costs, and these are all things you really need to consider before approving a deal. That's
incredible.
It's just amazing.
Is there a lesson you take from this? I mean, for a long time, I've been since I blew up a lot of money on Magellan, I've been really cautious about these asset managers. I mean, I do own Australian Ethical, and I do own a smaller micro equities fund, actually called micro equities. but apart from that, I've looked at GQG. I understand the attraction there, but I haven't bought it because it's a $100 billion fund manager, and it's not really what I want to do anymore. Are there any lessons here? Nick, let's start with you.
I think the lesson for me is acquisitions don't really work in funds management. So going and buying a bunch of brands and saying, oh, we can, cut out some central costs and perhaps add some scale, it doesn't seem to work. The large asset managers like Perpetual, even Janus Henderson and that have been made up from all these deals, and that's how they've added assets. They just don't seem to get any synergies from doing it. And I think if you are going to invest in the industry, you want to focus on the GQG of the world or the Australian Ethicals. I know they've done one or two smaller acquisitions that have their own brand, and it's just organic growth. I think it becomes hard because then you're managing so many different people, and we know in these businesses that if a star stock picker leaves, they can take the entire business with them, essentially. So these acquisitions I just don't think work. And then using debt and issuing stock to do them is just a double whammy as well.
Well, that's what's so beautiful about Australian Ethical. I don't think anyone can, I can't, I certainly can't. I challenge anyone to name a fund manager at AEF. No one goes there because of the star stock picking skills. It's really the ethical brand and the ownership of that ethical brand that attracts a lot of flow. And also it's got this superannuation product as well. But yeah, it's quite unique. Gus, what's the takeaway here?
I mean, structurally, these should be attractive businesses to that point you made before, because you don't need the difference between managing $100 million, your cost base, and managing 10 billion shouldn't be that much different. But they just, it really hasn't worked out that way in the Australian context. And consistently, the ones that, when they've gone public, people have managed to get a lot of money off the table, but they haven't rewarded shareholders. I'm not aware of any that have really been great, at least in recent years, that have done, have been sound investments. So there is a real cult of personality kind of built into these businesses, and that's even a hard thing to trade as a stock.
I should mention that the Intelligent Investor Funds owns Pinnacle. I personally own Pinnacle, and that's done. I think that's an exception, but that business model again is quite different. It's more of a distribution business than a funds business. So I don't think the lessons apply there. Sorry, Nick, continue on.
No, I was just going to say, I think just to Gus's point, that's why the acquisitions don't work in this sector, because you have got these star stock pickers at these companies that you go and acquire. And as soon as you acquire them, the star stock picker says, well, if I'm going to stick around, you need to offer me a big bone. And then so you don't reduce any costs. No one wants to make an acquisition and then immediately fund walks out the door because the star stock picker leaves. So it's just it's a really hard model to execute, and one that Perpetual obviously hasn't.
I also wonder a little bit, there seems to be a bit of an arcane art in exactly how funds get allocated. I think, there's a lot of behind the scenes machinations that can affect these businesses that can make them challenging to kind of invest in, I think, as well.
Yeah, I think that's really true, Angus. And being a shareholder of Pinnacle is kind of, I get that feel as well, that this is heavily a relationships business where your performance matters, absolutely, but your distribution strategy, the people who know one another, and your ability to please the gatekeepers, often the advisors, is more important than your ability to appease the final investor. So it's one of these. It's not as easy as it seems, and I actually think Pinnacle has the right idea. I think that's where the cream is in this industry. It's in the distribution. That's where that's kind of how you control FUM and how you make a fund manager successful. So that's the one I would back. But let's leave fund managers there. Actually, you know what? Let's move on to you, Nick, because I want to talk about John's Lyng, which you kind of described as a marketplace, which in our internal discussions, I've been a bit flippant and dismissed this business as a really expensive looking builder that's kind of jumped onto a climate change narrative, and it was crazy expensive and overpumped. And I think that stuff was probably true a little while ago, but more recently the price has really fallen back and has prompted you to take a closer look at it. Is this just another hyped up builder jumping on narrative, or is there something more going on here?
No, I think there is something more going on.
I thought you were about to say, it's a pumped up builder. Forget about it.
No. I think there is definitely, it's definitely a better business model than your traditional builder, like a Lend-Lease or a Stockland that does these big developments and those sorts of things. It really is a marketplace model is one way to look at it. It's also very much a relationship business. So what John's Lyng does is it provides damage assessments, cleanup, and then building and restoration services after insurance claims. So it's got to maintain all these relationships with various insurers and governments as well. And then it never actually does the building itself. It then has a network of 14,500 subcontractors on the other side that actually complete the work for them. So it's actually a really asset-light model. It locks in contracts at cost plus, so there's no fixed price contracts, which a lot of builders come unstuck with. And it also diversifies its revenues through multiple projects. So I think they did 135,000 unique projects last year. Again, some of these building companies, you can see one or two massive projects sees them come unstuck. That's not the case with Johns Lyng. And then it diversifies through customers. So there's no one customer that accounts for a massive proportion of their revenue. So it doesn't look like a traditional builder to me. It certainly doesn't have the metrics of a traditional builder. Return on capital has been extremely good. I think it's around 20% at the moment, but that's after a few acquisitions. So before them, it was close to 40%. So yeah, I think it's a relationship sort of marketplace model where they're almost connecting these insurers with this army of subcontractors and yet sort of sit in the middle as a bit of a middleman.
Yeah, it's the return profile that really gives this one away. It kind of blew me away when I was looking at the margins, and then the returns on capital are quite extraordinary. It tells you that there's definitely, this is not what you think it is. And that's always a good thing to do is to consider your expectations for the business versus what the numbers are telling you. It's a good sense check to see if you've understood the business model correctly.
Another feature is there's a lot of reoccurring work. So only about 20% of the insurance restoration side of the business is through catastrophe or disaster response. 80% is actually pre-recurring. So that's just regular weather events, wear and tear, building defects, those sorts of things. So they don't have to, constantly win these massive projects like other builders. That's just another small difference.
Yeah, right. Okay. So if I understand this correctly, so they pretty much link the insurance company to the subbies, to the subcontractors. Now, I understand why the insurance companies wouldn't want to go out and try and find individual subcontractors. It's not really their skill set and they don't want to get involved in that business. But why aren't there more competitors challenging Johns Lyng's primacy in that market? Because they dominate that space. And I don't see too much competition for them. What's the barrier to entry there?
Yeah, it's a good question, and it looks like there shouldn't be much of a barrier to entry, right? But Johns Lyng are the only company that actually do this nationwide. So they have 39 offices, and I think the CEO recently said their nearest competitor has like 3 offices. So no one can really do this work. Like if a disaster was in Cairns, for example, or one in New South Wales, then one in WA. Johns Lyng can do all of those, and they can do them at the same time because they've got this massive network of subcontractors. Other companies just don't have that network. So it's about building up your network of subcontractors, then winning the work off insurers. Insurers prefer the experience that Johns Lyng provides as well. And then from a subcontractor point of view, Johns Lyng has the most work, so you're always going to take their work over some upstart that might not be able to give you as much work or that's more infrequent. So it's sort of
hang on a second,
locks them in.
I think there's something going on here. So you're saying, I understand what you're saying, that for the insurance companies, having a large existing network is easier to deal with. And understand that from the other side, the subbies want to deal with someone who has a large chunk of work with the insurance company. So that makes sense. That means the local domestic market will be locked up, hard for new entrants to break in. But Johns Lyng itself is a new entrant into the American market. Now, why don't those dynamics hold there? If my thinking is if Johns Lyng can successfully break into that market, surely someone can break into the domestic market.
Yeah, so specifically to the US, I agree with what you said there. I think it's going to be hard for them to actually bring this model to the US. The only thing I would say is the US is much more fragmented. So Johns Lyng sort of had that first mover advantage where they expanded quicker than their rivals. and now they have this, now they're sort of the incumbent, and this sort of moat around the business. Whereas the US, there's a lot of different, you have to win individual cities, individual states. There's no real nationwide player over there. So it's to manage. I think that's how management would describe the US opportunity. It's more fragmented. We can come in, we can show, we can use our skills in managing disaster work or catastrophe work to then move into more standard sort of regular building defect work. But it's the right point. It's hard for me to see how they're going to dislodge some of those incumbents over there. They've made a big acquisition, Reconstruction Experts, and maybe they need to go and make 2 or 3 more of those.
Yes. It sounds like in the US, it's going to be a roll-up story, and you're really relying on the sensible capital allocation of management, which, by the way, may not be as a big gamble as it sounds, because these guys own stock. Lots of experience in managing the business, and their track record has been quite exceptional. So even if that is the case, that may not be a bad thing.
It was funny when I saw when I started reading up on this business, that the image that kept going through my head, because I lived in America for about 7 years, was just how dodgy construction is over there. The labor workforce for many contractors hang out in the car park for the Bunnings equivalent, Home Depot. And I had some friends over there who were Australians who had come from working in construction in Australia and moved to America. And I still remember one of them, I spoke to this guy when he had just moved there. He'd been there a couple of months, and he was just in this state of shock because on a daily basis, he was seeing things happen on construction sites that if you saw them in Australia and you didn't report it, you would personally be criminally liable for seeing such dangerous behavior. And he said that he was seeing that sort of stuff every single day in America, and there was no kind of accountability attached to it. And, to what Nick said earlier, every state's going to have different rules. Every city's going to have different rules. So I'll admit my eyebrows sort of went up above my hairline when I saw that they were expanding into America. But it could potentially be that bull case, because you're bringing that Australian structure from a much more kind of regulated industry into a very sort of disjointed market, and maybe it would work. It could work well there. Though I'm also mindful of the number of power companies and all sorts of of businesses in America that have gone out of business from natural disasters and having the insurance wrong, and it's a brave place to be taking a business into, I think.
The model over there is also a little different. So Johns Lyng wants to disrupt that model. So the model in Australia is essentially the insurer contracts Johns Lyng, and then that sends you out to that policyholder's property. Sometimes the policyholder will choose to go with another construction firm, but most of the time they'll just accept whoever the insurer sends out. Whereas in the US, for these housing associations, and they're sort of like our strata, the insurer pays out the strata, and then the strata then goes and contracts out the work. So Johns Lyng wants to skip over that and go direct to the insurer and say, you just send us to the jobs, sort of thing.
Right.
And that can save the insurer, a bit of money probably, so it can lower their claims expense, which is one of their massive costs, and just makes their operation a bit more efficient as well. But disrupting a model that's been in place for years is going to be tough, right?
Yeah. Yeah. Sometimes stuff that happens in the US makes no sense. It reminds me a bit of the real estate market over there. Like the cost they pay per transaction is something like double what they pay anywhere else in the world. And many companies have tried to change and disrupt it. No one has succeeded. I wonder if this might be another example of that.
I would assume the insurance companies, the magnitude of the waste they must have from people getting, dodgy claims and kind of having contractors charge more because, they feel like there's a blank check. If you can circumvent that, that's a pretty strong business case, I think. Even if it's only saving the insurer, a percentage a year, they would do it for sure.
Yeah, absolutely.
I was going to say, this is such a battleground stock, isn't it? Like, we can't even agree internally really what to do with it. And like, I can see both sides of the argument. So where have you settled, Nick? I mean, you haven't, you're probably not as negative as we've been in the past, mostly because the valuation has come down so much. But are you positive about it? Would you buy it?
I don't know if I buy it well, I haven't recommended to buy it at this valuation. So I would probably say it's a hold. We tell members we'd upgrade it when we are ready to buy it. I think the risks about the US that we spoke about are there, but there's also that, it's a $100 billion market. It's a massive opportunity. But it does risk spreading management too thin. It also might indicate that management are looking for other ways to grow. So they've also recently been rolling up the Australian strata management industry, and they've also bought a services business, a smoke alarms business as well. And there are some synergies across these businesses. But it just makes you wonder, are they expanding into these different areas because that they see that the growth, which has been about 15 to 20% a year in the insurance restoration business within Australia, is actually going to, come back to mid-single digits or high single digits, and maybe can't support the valuation. At $9 a share, the valuation was like 40 to 45 times earnings, which was pretty up there. It's now down, I think, below $6 a share, and it's much more comfortable valuation at sort of 26, 27 times. The other swing factor here is how catastrophe profits play out. This year's going to be a pretty weak year, so it'll be roughly half what they earned last year. And next year, there hasn't been many catastrophes declared by the Insurance Council of Australia recently. So next year's profits in that area are probably going to be maybe even to lower as well. But this is the time you sort of want to be looking at the stock when a few things aren't going its way. So it's a long way to say probably a hold at the moment.
I like that prediction. You heard it here first. No catastrophes next year.
Yeah. Well, yeah. It's sort of you need them sort of the year before, if that makes sense, because then they go and do the damage assessments.
Right.
Yeah, so for example, last year, FY23 was their biggest year ever in catastrophe revenues and profits, and that was mainly because of the East Coast storms in March 2022. That was the Lismore floods and those sorts of things. But that actually flows through the next year rather than the current year, depending on when they land, of course.
Wow, it is something that I do like a lot about this business. If you look at what is happening with global mean surface temperatures, or the more alarming one is ocean temperatures, because the ocean's better at storing heat. The rate of natural disasters is just going to continue to increase, and so I think a business that kind of sails in the right direction with that is I think it's a strong argument for the stock.
Gus is a bull.
He's a bull.
On that aspect, I'm certainly a bull. A bull on the very bearish subject of increases in natural disasters.
I'm on the fence so far. You've done some good work on it, Nick. You've turned me around a long way, but I probably just need to see a bit more from the business. I don't like the acquisition. The last couple of acquisitions they've made. I think if they just focused on one thing, either move into adjacent businesses in Australia and try and expand what they do here, or focus on rolling out in the US. I don't like them doing both at the same time. They both are difficult tasks and they require a lot of attention and care. They picked one and stuck to it. I'd be more inclined to buy in. But for the moment, I'm on the fence. I can see the point. It's definitely. I popped it on my watch list. I've got a watch list of stocks that I watch. It's hence the clever name. It's on that list. It's hard to get on that list. There's only like 30 companies on that list of all ASX listed companies. That John's Lyng is now on there for the first time. So I'll credit you with that, but not quite there yet for me. A company that's definitely not on my watch list is one that Gus has been working on the last little while. Gus, you've been looking at a little business called Doug, which I must say has pretty decent financials when you look at it. And it's like, I've never heard of this business, and it's making money and generating some growth. So tell us about this one.
Yeah, I mean, I think what they do is just so interesting, this business. They basically provide super compute services.
Just tell us the name and stock code, because lots of people never have heard of this before.
It is, the stock is called Doug, and I believe it's Doug ASX. I think it's Doug, okay. DUG ASX.
Finally, a code that matches the name. You know how much PWR and PWH have just caused me so much sleep headaches. So annoying.
Likewise.
So Doug, very easy stock code to remember. The name gives it away a little bit. It is they largely service the mining industry and kind of oil prospectors, that sort of thing. And so to kind of go to the bones of why you need this business, is it's very hard to actually look at under the surface of the earth and find out what minerals are below your feet, where the oil deposits are. And so the way that you're normally doing that is through seismic imaging. So you either have seismographs stationed in all around the surface of the earth, and because sound waves move through the earth, they move through different rocks at different velocities. So you can triangulate to what the earth looks like under your feet, and it's a slow process. You need to build up a lot of data. That a lot of these things, they actually use ships that go over the ocean, trailing, often kilometers behind them, long ropes with basically listening devices, and they're shooting sound waves into the sea floor. They're probably what mess up the migration of whales, because these sound blasts probably cause all sorts of chaos for the whales under the water. But anyway, once you've collected all this data,
higher temperatures and sound blasts through their homeland.
yeah, it's a slightly grim thing to do. But that's how we sort of map what is under our feet. And once you kind of get that data, you've got to do this huge amount of image processing on it. So you really need supercomputers, and they're doing, like a lot of super computation, it's just doing very simple mathematical steps many, many, many billions of times. I think it's a fascinating industry. I'm very interested in supercomputers, but they're extremely capital intensive. The technology moves exponentially, so they have very short shelf lives. This is sort of reflected in a very short depreciation schedule, but it's this sort of high capital intensity. And what I also don't like is that Doug is probably 80% of its revenue, maybe more, is really reliant on the amount of oil prospecting that's occurring. So it moves a lot with commodity cycles. It looks like they'll beat it this year, but peak revenue was in 2019 I think it was 2019. So this is quite a sort of, you've got a cyclical commodity, you've got an exponential technology, and you've got infrastructure that's extremely capital intensive. And those factors combined make me not love this business as an investment, but as a nerd, I really like the business.
Well, the what to look at question should start as a nerd, and the what to buy question should finish as an investor. So I think you got that perfectly fine there.
Only from making that exact mistake and not realizing that many times in the past.
Hey, just explain something, because this is interesting, but also for us mortals who aren't supercomputer nerds, it's a bit confusing as well. So just where in that service cycle does Doug sit? Do they provide the compute power? Do they provide the seismic gear? Where are they on that service line?
Yes. So they own some supercomputers. They had 4. I believe they've now got 3. And to that point of...
So there's an ASX listed business worth only a couple $100 million that owns 3 supercomputers.
Yes, indeed.
I had no idea.
They've got one in Houston, they've got one in Malaysia, and they've got quite good names. So there's Baza was the one in London that I believe they've now sort of decommissioned. Bodhi, which is in Malaysia. Bruce, which is in Perth. They also have a sort of product where they have basically built supercomputers into shipping containers so that you can kind of move it on site to the mine. And they sort of publicized a technical breakthrough a couple of years ago, which they call multi-parameter full waveform inversion imaging.
Oh yeah,
and it essentially, you know, that they filed patents for it, and they sort of said that they did have this kind of have a sort of breakthrough. But so they've got a services business where basically the miners give them their data and they supercompute it. They've also got software, and then they also kind of do this high performance computing as a service. And they had a cloud product which still gives them a little bit of revenue, but basically their business that's growing tremendously, you know, sort of over 50% is this 50% per annum is this services business where they're you know, taking a large mine or oil company and kind of processing the data, and the data sets that these companies get, they might process it 3 or 4 times. So, you know, there's quite a long tail and an argument of work for the company, a long tail of work. But they've said that the business is counter-cyclical because the miners, when they're kind of, even if they're worried about the price of oil, so they're sort of not going out looking as much, they might still be interested in kind of recycling and looking at those data centers again. They also do service science, so you know, drug discovery. They do a lot of stuff with astronomers because astronomy is really fundamentally just image processing. An awful lot of it is anyway. So they've got a few sort of business units, but really, you know, last year half their revenue came from Texas, and it's really been connected quite a lot, I think, to the oil shale boom that you've had in America. You know, America is now the largest producer of oil in the world, by a significant amount too.
Nick, what do you make of this? Would you look at this? Would this deserve a spot on Nick's watch list?
No, probably not. I did have to laugh a minute ago that you've got this sort of ASX technology company that is the only one doing supercomputers, and most of that is directed towards commodities. It can only happen on the ASX.
That's a very good point.
But no, I think this, picking up on something that Gus said, it doesn't seem to make much business sense to me, or, you know, be the potential for a successful long-term investment if you're investing millions of dollars in this upfront infrastructure and capex.
Yep.
And then relying on these, you know, volatile revenue streams linked to the oil price coming through to pay, you know, to make a return on those investments. It's sort of like, you know, Transurban building a road for, you know, each year that road, you know, the traffic, you know, changes by 10 or 20 or 50%. It wouldn't make much sense. So, you know, for that reason, I'm probably not interested. But as Angus said, it's pretty interesting stuff. The technology behind it, and that, you know, that we're looking below the Earth's surface. And I think he said in the article that it's easier to look light years away than look beneath our feet. just incredible.
Yeah, there's it's a bit of an aside, but I did physics at the ANU, and the guy who was the smartest guy in our year, I would argue, was a very, very brilliant guy. I remember he's the only person I've ever said make a sort of throwaway comment about winning a Nobel Prize, and he said the easiest Nobel Prizes, he was going into geophysics because he thought that's where the easiest Nobel Prizes were. We really have quite a limited understanding of kind of, you know, how exactly to sort of peer into the interior and our data. You know, it's amazing what we can do in some respects, but in other respects it's surprisingly limited. But, you know, I think that you've really sort of hit the nail on the head there with the you know, having to rebuild a road every 5 years is a tricky thing to do, and it's potentially worse than that, because at least a road, it's like having to build a road every 5 years, but you don't know what a car's going to look like in 5 years' time, because, you know, you might have flying cars, or you might have, you know, this is an industry that is changing at such high velocity. You know, in the article, I looked at the Cheyenne supercomputer, which went up for auction, and this thing, you know, over 100,000 cores in it. It weighed over 10 tons. It, you know, cost $35 million, and I think it ended up selling for about $400,000.
Wow.
You know, in 2016, the 20th most powerful computer in the world. Now, kind of buying it for less than the price of a Ferrari. And that's another aspect, another dimension that's difficult with this. One is when you're building these supercomputers. So I previously in another part of my career, I worked a little bit with some guys who were doing crypto mining. And it's actually getting the power supplies in place, getting the cooling, getting the contractors who have the expertise to build this stuff. There's actually a lot of execution risk in even building supercomputer infrastructure. And it's very, very state protected. So, 8 of the 10 fastest supercomputers in the world are state-owned. So there's a huge amount of kind of state intervention because a lot of these things, it's really pure research projects that you sort of build these for. So, you kind of connect that risk to a business. Certainly commodities in Australia, there's going to continue to be a lot of demand there. But it's just a place. And then the other thing that kind of really ultimately was a factor that sort of put me a bit south of the business is they've had a lot of management turnover. You had something like 3 CFOs in about 4 or 5 years. I don't really like to see that. I find that that's a pretty solid red flag, I think, in terms of, when you're looking at a business. I try and buy businesses for the long term, and that makes me a bit twitchy.
Yeah, no, I completely agree with that. A succession of CFOs is worse than a succession of CEOs, because a CFO typically leaves if something looks really bad or really dodgy. The CEO may have ambitions or job offers elsewhere, more of a volatile character potentially, but CFOs should be the nerdy accountants. And if they're leaving in one after the other, that's telling.
Yeah, I think so. And, one of them I think lasted something like 8 months, and you had a company secretary, and, this was sort of around the time, so they went public in 2020. So, sometimes you do get executives that come on board to take a company public, but, it definitely makes me nervous when your general counsel leaves after 10 months.
Plus, I think if you've seen the latest Godzilla movie, they've figured out what's at the center of the earth. It's just a hollow sphere
you might be right.
Monkeys. Filled with giant apes. The business is doomed already. They just don't know it. All right. Doom is a perfect place to end as well. Gents, thanks for your time today. Nick, very good of you to join us, and nice to hear from you.
Thanks, Gaurav. Thanks, Gus.
Gus, I should mention that you made your inaugural TV appearance on Insight last week, and I think that's probably showing up this week. So if anyone wants to see Gus talk about, I was going to call you Doug. I want to see Gus talk about dating, his dating history and the dating apps. Check out Insight.
Business of dating and my dating history. Yeah,
that's right. Well, that's what we're tuning in for.
Sordid tale.
Thanks for your time today, Gus.
Thank you.
And for everyone else, thanks for listening.